In the United States, taxes are collected at both the federal and state levels. While both systems aim to generate revenue for the government, they differ significantly in structure, rates, and the way they impact taxpayers. Understanding these differences is crucial for anyone navigating the U.S. tax landscape, as it directly affects how individuals and businesses plan their finances. Federal taxes are typically uniform across the entire country, whereas state taxes can vary widely depending on where you live. In this video, we'll explore the top 10 differences between the U.S. federal and state tax systems, highlighting how each level of taxation impacts taxpayers and the services they help fund. 1. Tax rates. Federal versus state. One of the most noticeable differences between the federal and state tax systems is the tax rates. At the federal level, tax rates are progressive, meaning they increase as income rises. The federal income tax system has 7 tax brackets, ranging from 10% to 37%, as of 2023. On the other hand, state income tax rates vary widely from state to state. Some states, like California, have progressive tax systems similar to the federal one, with multiple tax brackets. Other states, like Florida and Texas, have no state income tax at all. This means that in certain states, you may only be subject to federal taxes, significantly reducing your overall tax burden. 2. Taxable income. Federal versus state calculations. The way taxable income is calculated can differ between federal and state tax systems. While the federal government allows various deductions, exemptions, and credits to reduce your taxable income, state governments may have their own set of rules and adjustments. For example, certain states may not allow all federal deductions, such as mortgage interest or state income tax deductions. This can lead to different amounts of taxable income being reported on your state return compared to your federal return. Additionally, some states offer unique deductions, like deductions for education expenses or contributions to state-specific savings programs, which are not available at the federal level. 3. Sales taxes. Federal versus state. In the U.S., the federal government does not impose a national sales tax, leaving that responsibility to individual states. Sales tax rates and what goods and services are taxable vary from state to state. For example, California has a base state sales tax rate of 7.25%, while other states like Delaware, Montana, and New Hampshire do not have any state sales tax at all. Some states also allow local governments to add their own sales taxes on top of the state rate, which can increase the tax burden on consumers. This significant difference between federal and state tax systems means that the cost of living can vary greatly depending on where you reside. 4. Property taxes. Federal versus state. Property taxes are another area where federal and state tax systems differ. The federal government does not levy property taxes. This is the responsibility of state and local governments. Property taxes are typically assessed on real estate, land and buildings, but some states also tax personal property, such as vehicles or boats. Rates vary widely, with states like New Jersey having some of the highest property tax rates in the country, while states like Hawaii have some of the lowest. The funds generated from property taxes often go toward local government services, such as schools, public safety, and infrastructure, which can directly impact your community. 5. Corporate taxes. Federal versus state. Both federal and state governments impose taxes on businesses, but the rates and rules differ. At the federal level, corporate income is taxed at a flat rate of 21%, as of 2023. This is relatively straightforward for businesses operating nationwide, as they are all subject to the same federal corporate tax rate. However, states impose their own corporate taxes, which can vary widely. Some states, such as Delaware, are known for their business-friendly tax environments, offering lower corporate tax rates and favorable business laws. Other states, like New Jersey, have higher corporate tax rates. States may also offer credits, deductions, and incentives for businesses operating within their borders, making the state corporate tax environment more complex than the federal one. 6. Estate and inheritance taxes. Federal versus state. Estate and inheritance taxes are another area where federal and state systems diverge. The federal government imposes an estate tax on large estates, those valued over a certain threshold, which is over $12 million for individuals in 2023, but it does not have an inheritance tax. Inheritance tax is typically levied by the state on the value of the property inherited by the beneficiary. However, only a few states, including Maryland and Nebraska, impose inheritance taxes. Estate taxes at the state level can also be significant, with states like New York and Massachusetts imposing estate taxes on estates valued over much lower thresholds than the federal government's threshold. The differences in estate and inheritance tax rules can lead to significant tax planning considerations for individuals with substantial assets. 7. Tax filing. Federal versus state deadlines and processes. While federal and state tax systems share some similarities in the filing process, there are key differences in deadlines, forms, and procedures. For example, the federal tax filing deadline is typically April 15 each year, but state filing deadlines can vary. Some states have a different deadline, while others may grant extensions for taxpayers who need more time. In addition, many states require separate state tax returns to be filed, while others, such as New Jersey and Pennsylvania, allow residents to file a single state federal combined return. The state filing process can also differ in terms of the forms used, how to claim deductions or credits, and where to submit your return. 8. Tax credits. Federal versus state eligibility and amounts. Both the federal and state tax systems offer various tax credits to reduce tax liability, but the credits available and the eligibility requirements vary significantly. At the federal level, popular credits include the Child Tax Credit, Earned Income Tax Credit, EITC, and the American Opportunity Tax Credit for education expenses. States may offer similar credits, such as credits for child and dependent care, low-income housing, or state-specific education expenses, but they may have different eligibility requirements and amounts. For instance, California offers its own version of the EITC, with a separate set of income limits and benefits. State credits can significantly impact how much you owe, and knowing the differences can help you maximize your refund or reduce your tax burden. 9. Taxes on retirement income, federal versus state. When it comes to retirement income, federal and state tax systems vary in how they treat distributions from retirement accounts. At the federal level, traditional IRA and 401k withdrawals are taxed as ordinary income, while qualified Roth IRA withdrawals are tax-free. States may or may not follow the same rules for retirement income, and many offer special provisions for retirees. For example, Florida and Texas do not tax retirement income at all, making them attractive for retirees. In contrast, states like Vermont and New Jersey tax a portion of Social Security benefits, pensions, and other retirement income. Understanding how your state taxes retirement income is essential for retirees when planning their income sources and living expenses. 10. Use of tax revenue, federal versus state priorities. Finally, the way tax revenues are used differs significantly between federal and state governments. Federal tax revenue is primarily used to fund national programs such as defense, Social Security, Medicare, and federal infrastructure. States, however, focus on local services, such as education, healthcare, and public safety. The allocation of tax dollars often reflects the priorities of state governments, which can vary greatly. Some states may prioritize funding for education, while others may allocate more resources to public health or infrastructure. Understanding how tax revenue is spent at both levels helps taxpayers understand the impact of their contributions and the services they receive in return. The U.S. federal and state tax systems are complex and significantly different in many ways. From tax rates and taxable income calculations to the ways in which taxes are used to fund public services, these differences can impact your finances in a variety of ways. Understanding the distinctions between the two systems is critical for making informed financial decisions, whether you are filing taxes, planning for retirement, or starting a business. By staying educated about federal and state tax laws, you can better navigate the tax landscape, minimize your tax liabilities, and optimize your financial situation. Ultimately, being proactive and understanding these differences ensures you can make the most of the tax benefits available to you, no matter where you live.